Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys!
December 7th, 2018, episode number 5. This is Patrick Ceresna.
And I'm Kevin Muir. Thanks for taking the time out to join us this week. The Market Huddle is a weekly show where Patrick and myself get together over a couple of beers to talk about this week's action in the market, making sure to keep each other's feet to the fire and have a little fun in the process.
If you're enjoying this episode as a podcast and want to see the charts or the videos that we're showing, make sure you catch this either on YouTube or register on our website, and we will send you a link with a chart book attached. So in this week's episode, we're going to touch on the most important things that happened this week: yield curve inversion and market turmoil.
In our This Week in Trading History segment, we remember back to the savings and loan crisis. And for this week's WTF clip of the week, where we have Krugman, Trump, and Powell. Well, let's just leave it at that.
No problem. And so in the Tales of the Trading Desk, we're going to talk about one of the greatest risk arbs of all times. And then we're going to end it with the 5 most important things all of you need to watch next week. So let's jump right into it. So Kevin, who is the show brought to us by this week?
Well, this week, Great Lakes Brewery stepped up to the plate, and they have a very appropriately named beer they sent us. It is the Pompous Ass English Ale. So let's...
Sort of like you, right?
Yeah. Let's get to it and see what we think.
Oh my God, that's foaming up everywhere on me.
Well, that's quite nice. I like that.
All right, so Kev, get to your housekeeping. I'm going to keep drinking this beer, but get that housekeeping out of the way.
Sure, sounds good. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com.
So Kevin, what was the most important event of the week in your mind?
It was the thing that was on everybody's lips, and that was yield curve inversion.
Well, if you were directly above him, how could you see him?
Because I was inverted.
Bullshit. No, he was, man. It was a really great move. She was inverted.
So Kev, what did I text you in the middle of the week?
Well, you texted me. All I saw was that an inversion?
I had to double check because, first of all, it's a big deal. Like, we haven't seen an invert. Everyone's been, what has it been, 3 years we've been talking about, will it invert, will it invert? Like, this is the first time since 2007 that we've seen an inversion.
Yeah, and it's not a complete inversion, and we're going to go into the details about what exactly we saw.
Yeah. But
you are correct that for the first time since that point, we have a point in the yield curve that as you go further out the yield curve, it is a lower rate than the closer month one.
So let's explain to our listeners that are not familiar with yield curves on what yield curves are. So we're looking at the different structure of interest rates. And so to describe it is everyone goes to the bank to get a mortgage. And when you go to the bank and mortgage, you'll see that you can get a 2-year mortgage for 3%, and then you can get a 5-year fixed for 5%. So that as you pin all of the different mortgage rates, it creates a yield curve, which is how much more you're paying by adding time to your mortgage. And so the yield curve inversion is, if all of you can imagine, is where that 2-year mortgage costs you more than locking in for 5.
That's right. And usually a regular yield curve is upward sloping, where every month has a higher rate, or every kind of
month or year or whichever
has a higher rate than the kind of the shorter dated
and that
one.
Makes sense for all the doomsdayers on the U.S. government. Why would you lend Trump money for 20 years at a cheaper rate than you would over 10, right?
That's right. But the thing about the yield curve and the signals that it sends, and we have to think about this, is that the U.S. government bond market is the largest market in the world. And it has the most market participants, and it is giving the collective wisdom of the market of where they think interest rates are headed. Because although the Fed controls the short end of the curve, the long end is set by the market.
Right. So the bond markets are incredibly important, and particularly the bond traders are the smartest guys in the room.
Yeah.
And
As an equity guy, I can tell you that the bond traders are much smarter than the equity guys.
absolutely. And so you have a scenario where when this is why we like to listen to the yield curves and the bond markets, because they tell us the story of what is really happening in the economy. So this first chart shows, was it a month ago?
That's right. It was the yield curve of the U.S. Treasury market a month ago.
So now when we go to the second chart here, what are you showing us here?
So this is the yield curve and how it moved after Chairman Powell's comments when he made the dovish shift.
Dovish shift. That was not the October 3rd. This was the
This was the recent
one
last week where he went and said that we're closer to neutral than we expected.
Absolutely.
And the interesting thing about it is you can see it in this curve, the flattening.
Yes.
And the way you can see it is the green chart is the green line is the actual curve a month ago, whereas the orange line is the yield curve last week.
And now, is that is the bump at the 1 month because everyone sees this December rate hike as being baked in? Is that
That's right. He put it up. So he kept saying that rates are going to continue rising over the short run, but in doing so, the front month went up. But if you look at so we kind of look here, the 1 month went from 208 to 230, but then we go out to the 10-year and we'll see that the 10-year went from 320 down to 308.
right?
So not only
So what does that mean? Is that's basically the market predicting that we're going into an economic slowdown sooner?
That's correct. It's a flattening. So they're thinking that the Fed is basically raising rates into a recession.
Right.
And we can see that this trend of the near months going up and the long months going down continued when you look at the next chart, which is the yield curve as of a couple of days ago.
That blue line looks like a complete flat.
That's right. And
there's a little inversion in the middle.
And
but
that is the inversion that you texted me about.
Yeah.
And specifically what happened was the 2-year went to 280 and the 5-year dropped down all the way to 279. So what that means is that the yield curve is inverted, and it's not a true inversion, because when you get a true inversion, we'll see the kind of the 3-month up at like 320 and then the far end of the curve down.
Right, you're basically saying that the Fed is overshot, and when they're overshooting, they're going to basically push the Fed funds rate to a level that's higher than the long-term rate of interest.
Well, as they push up the Fed funds, investors realize that can't be sustained, and therefore buy the long end of the curve. Because the other thing you need to realize is that what is a long-term bond investor's worst nightmare apart from default?
Inflation.
Right. And what's the best thing to stop inflation? Tight money.
Yeah.
So it's kind of paradoxical, but tight money is actually the greatest thing for a long-term bond investor. And so
it's deflationary.
That's right.
But so is too much debt. We'll get into that.
So now if we go in, we're gonna kind of center in on that 2 and 5 year spread, because that's the part that everyone was talking about. That was the point that actually inverted this past week, and you can see
that's where it's going right below the red line, all the way on the right hand side.
That's right. So this is the chart, and you'll see that.
So for those listening to the podcast, what we're showing is going back to 1994, and we're basically marking the two major inversions, which were in 2000 and in 2007, where the yield curves went below zero on the 2s and 5s in terms of interest rates.
Right, and that's the point that gotten everyone into kind of whipped up to a lather about the fact that we're now inverted, and therefore, if you look, a recession followed that point. Now, the real question is, how long did the recession follow, and is this for sure going to happen again, and are we going to bounce? And there's a million questions. It's not answered. Like this isn't the be all and end all of an economic indicator.
Right.
But it's certainly a big warning sign, and that's how I'm taking it. The other day I was listening to a podcast by Meb Faber, and one of our fellow Canadians, one of the smartest guys around, David Rosenberg, made a comment that just struck me as so smart and so well put. I had to kind of quote him here. And I'll read it out. The risk to the economy is not that the Fed is going to raise rates too quickly. It's that when it comes time for easing, they will be way too slow.
But that to me is the story of the Fed or all central banks in almost. Well, tell me a situation where a Fed or any central bank in the world was just too quick and they eased too quickly. Do you know a story?
No, you're correct. But what is the important part to realize is that we're now at that stage in the market cycle where instead of the market being worried that they're raising rates too fast, they're worried that they're going to be stuck too high for too long.
Yeah.
And
that makes sense.
And that's, to me, the big takeaway from this recent.
So let's put this in perspective for our listeners. What will end up happening, by even just saying that they're data dependent, data in itself is lagging. There's leading indicators out there, but the Fed is more or less dependent very much on data that comes in from what happened last month. Even if you get a funny print, okay, like the jobs numbers in Canada, which came in really hot, which to me, you can't, polos can't react on just one data print like that and suddenly say, it's running too hot, we got to move. They need multiple data points to identify a trend. And so you have a scenario where it's just a function of being data dependent, that you need lots of data samples to determine whether or not they have to act. And they're simply, the economy is going to be fully slowing down, and they're just going to be denying them the liquidity that it needs.
That's right. And so, but the important thing to realize is that then short-term rates will be too high for if we make that if we have assumed that the market has rolled over, the economy has rolled over, and that short-term rates then therefore are going to be stuck too high for too long, and that is why the 2-5 spread has actually gone and inverted,
right.
Because investors have collectively decided that the 5-year, kind of, 3 years out, the Fed's going to be lowering rates and we're going to have a recession in the next little while.
This is definitely a different inversion than what we saw in 2006, 2007, because there Bernanke was firing off those rate hikes and pushing it way too high, and the short-term Fed funds rate blew past the entire curve. Like it
That's right. But the important thing to realize during that period was he left rates unchanged for a long period, and the whole market was screaming, you're too tight, you're too tight, you're too tight, and they were again slow to react to lower rates.
Yeah.
And that's what you should also expect now. And so when we look at the different parts of the curve, when we're trying to determine where we are in this timing cycle, you'll see that the 210s have gone down from 250 basis points in 2013 down to 14.
Yeah.
Now, will they invert? I don't know.
So the 2s and 5s inverted, 2s and 10s have not, but they're only at one point they were only like 11 basis points away. I think at the bottom end. Point being that it's pretty much as close as to zero. I think I think people get too caught up in whether it's a negative number or not. To me, it's about the trend. And the fact that it continuously is flattening is the more important message than whether it inverts. Am I wrong?
I can't disagree with that comment. But the interesting thing about this cycle is this next chart, which is the 530.
Right.
And you'll see the 530s are actually steepening.
Right. So on the next chart here, you're overlaying. Now you just made. I think you just had a typo here, where because I think it's the orange is the 2s and 10s, right?
That's right. So
okay.
You'll see we put the 3 different yield curves up here, the spreads, and had a look. So you'll see the 2-5s gone, to zero.
Inverted.
Inverted. The 210s have gone from 30 basis points down to 14. But in that same period that the 210s have gone down from 30 down to 14, the 530s have gone from 30 up to 44.
Is that where your steepener is?
So that's, to me, the
where are you on the steepener?
I own 530s.
So you're okay right now.
So I actually, when Chairman Powell went dovish, I came to the conclusion there was no reason to own anything shorter than 2, because even if it was going to be stuck here. The Fed is not going to go from raising rates to cutting rates anytime soon. So therefore, 2s are probably just dead money. So I moved out to 5s. And I still think that in the long run, that the real big money will be made through steepeners. And the reason I think that they're going to be steepeners is because of this next table.
Yeah.
And this.
So but I'll agree with you because, and even that was something on Macro Voices when we had Charlie McKellick on. He's saying, you don't have to fear the flattener. You got to fear the steepener. And almost always after an extended flattening of the curve, there's a steepener that comes, and the steepener always brings turmoil. But what's your thought here?
Well, my thought is that the world's central banks cannot afford to have a flat curve. They cannot afford to have high rates. And I sketched out a chart of the debt to GDP of various countries from 2003 to 2017. So you can see that Japan went from 155% of GDP to 236.
That's about an 80 basis point increase.
Yeah. Italy went from 106 to 131. France went from 69 to 97. Canada, 77 to 89. United Kingdom, 51 to 87. And the United States, 62 to 82.
So interesting. Another interesting stat. Even though this is adjusting that way, but what's interesting is the global credit stock of debt in the world went something from like $125 trillion to $250 trillion in this cycle. And so we've had the total credit stock. So, I mean, it's nice looking at percentages, but the total outstanding amount of debt. And so when we say credit stock for our listeners, that we're talking about all forms of debt that were created through the banking system. And that debt has doubled. And so what happens is that debt has to be serviced. And that's where me and you have the inflation deflation debate about debt. And I fall more in the Lacey Hunt camp. You're on the other side. But this is a debate I think we got to have over and over again moving forward, right?
But the important question to ask is how much tightening can the global economy take? And I contend that we've hit it, and that the Fed kept raising until they broke something, and something broke. And the next move after that, we're going to have one more raise in December, and then that's going to be it. The next move is a pause, and then from there it's going to be cutting, and the Fed is going to be too slow in cutting as their economy rolls over. Okay, Patrick, that's it for me. What do you think was the most important thing this week?
Well, we talked about it last week. But how can we not keep talking about the price action in the S&P 500 and the whole markets around the world, and really asking the question, will the bloodletting in the market lead to 52-week new lows in the S&P 500? Just today, we saw the S&P 500, attempt a little bit of a rally and then gets hammered into the close.
Yeah, and we go back to that the G20 move after the weekend when we came in Monday morning, and there was a huge gap up.
Kudos to you. Kudos to you. Just for our listeners that didn't listen to the last episode, we were both in consensus that there was going to be a pop and drop. But I felt...
Whoa, let's stop, because the pop and drop was not as good a name as Patrick's prairie dog formation, which I loved. Like as I said, it's a very noble creature, and I just love that he's got his own.
All right, so we were both convinced it was going to prairie dog, but we were a little bit different. I was convinced it was going to last longer than a day. Right. I thought that we could last even a week or more, and we could even press north of that 2,800 level on the upside before it reversed. And you were more convinced that this thing was just going to pop and drop right there, and then it was going to fade right off that. And you know what? On balance, I'm going to give you the kudos on this one.
Well, that's kind of you.
Because it really did not give a long enough opportunity. If you didn't act on the Monday, you missed it.
The market is rallies are to be sold. We're in a bear market. I'm convinced of it. Money is too tight, and
it is. So on the chart we have the S&P 500, and so I wanted to just point out with a little arrow. So we're showing the arrow around that little gap higher to the 2,800 mark. Paused up there, and then just the next day it dumped. We lost 100 S&P points in 24 hours.
It was ugly.
It was ugly.
You know, I know I'm no technician, but I would say those big red bars are bad.
The big candles. The candles.
Okay, I'm sorry, the candles. I didn't even get that right.
But what's interesting is that for those that can't see the chart, is we went and now retested the late October and mid-November lows. Right. And so we find ourselves in just a few days, and I always describe it like very much like the picture we had from last week, which is that you're at the edge of a cliff, and the market's hanging over the side, and you're just wondering whether it's going to lose its footing. Because there's a ledge that has a very big drop coming on the other side of this.
Well, what's the joke? There's no such thing as triple bottoms. Like the more often that you go to a level and test it, the more likely it's going to be broken.
But isn't it interesting? Back in February, and this is the saving grace. If you go to the chart back in February, is arguably there were 3 tests of all these lows that occurred. There was that one, the February drop, the late March retest, and then in May we had one more dip, but it was immediately bought.
That's right. If you look at it, it's a wick, right? Like I know enough about the candles to say that's a wick.
Exactly. It was immediately bought. It went down and immediately bought.
As opposed to today, where it was sold and then
stayed down.
Yeah.
Like because it's almost like market participants are tripping over themselves to get out. And they're trying to get in their orders before the other person. It's like yelling fire in a theater, and there's only one exit. They're all trying to push their way ahead of the crowd to make sure they get out. And it's to me though, it is important. And so again, using that technical squiggles that you love to kind of rip into me into, but. What's interesting is that if we break these lows, there is still always the possibility the Feb lows can offer a reaction. It's always possible. But because of the bigger macro landscape, I just like you, I'm far more bearish. I feel generally that on balance. But what I really did think there could have been a chance that there could have been a Christmas rally. But you know why it bothers me about Christmas rally? Is it was so consensus. I couldn't believe how many people were so goddamn convinced that there was going to be a Christmas rally. And I hate to be in the company of a big herd of investors that all think the same thing, especially when they have something at stake that needs that to happen.
Well, you and me both hate that. But if when you look at the Christmas rally, isn't it more just those few days? Like, it's not the whole month. When people talk about, I think a lot of people confuse on the Christmas rally what the actual tendency is. It's the tendency for it to rally in the last few days of December, not for the whole month. We still, we're early on in December. I could still see a Santa Claus rally. It's just we start from a lower level.
So that's possible. But I want to rewind. Actually, I'm going to put it on a weekly chart. I'm going to rewind to 2007, the last bear market we had. Now, of course, like you said, there's echoes. It doesn't always play out the same. But what I thought was particularly interesting is that when the S&P 500 was sort of messing around with its bottoms through July and then all the way into November, when the market broke in December and went into January 2008, so December 2007 and 2008, that was when that low gave out. That marked a floodgate opening, and that if we were to use equal proportions from a technical perspective, we would go to 2,400 on the S&P in short order in order to get a move of this magnitude.
Okay, so here's where we'll disagree. Because although I am bearish, I think too often people dream up 2007 style kind of crashes, and they assume that that's what this is going to look like.
I'm not assuming that. I always use it as a reference point.
I know. I think that's too easy. I could see much more likely than that is just a drip, drip.
I don't buy that. Yeah. I don't buy that at all. Okay. You know what? Okay, look.
That's what makes a market.
Yeah, but you know what? Once everyone realizes, let's go back to what the problem with the markets in general today is that we had this massive shift to passive investing. There isn't enough active managers. I think there's a point where at the end of the year, when all of the year-end performance numbers come out and everyone realizes what's going on, I think there's going to be a lot of people that realize that they're not as comfortable with passive investing as they always thought they were.
So do you anticipate that like in December or January when they get their December statements?
At this point, I'm not so... See, I feel my confidence level that in the first quarter of next year that the market will be considerably lower. But to be honest, I'm a little bit surprised that this is already as weak as it is, as fast as it is. And this actually worries me more than anything, because I actually thought this would be more like you just described, more of a trickle. To be honest, if this was just a distributive pattern and sellers aren't putting the market down on themselves, they're just distributing into highs and the price action was just very distributive, This to me looks like they're fighting to get out at the best price, and I don't know. I don't feel good.
You don't feel good. Well, I'll take.
Well, I will actually feel good as a short, but I'm saying I'm looking at it from a perspective of being long.
And I understand the possibility of a flash crash. I understand how the dynamics of the marketplace have changed. And I won't deny and say there's no way that'll happen. All I know is that there's a fair amount of chat about it. And I would say probably the least,
there's more chat about a Christmas rally than there's more chat about a crash.
Well, okay, but I would say the least chat is about just kind of a slow drip lower. That would be the one event that nobody thinks is going to happen.
So, okay, let's use the China A50 as an example, which is in your mind this the slow drip?
Yeah, that would be it.
But notice that it first wiped out 20% before it slow dripped. All right? So
you think you're going to have a 20 and then a slow drip?
I feel that the first thing that has to happen is like a big, stronger drop. Like if you think about this in 2007, again, accepting your theory that it's not going to play out the same. It's not. But after that January low, up until May and June, the market actually went higher. So actually after the January low, it spent another 4 or 5 months kind of mean reverting that drop. And this bear market, even though we were in it, that's where your slow bleed at the time was. And I think that there's just as much of a possibility that we're going to slam to the downside, and then we're going to kind of have a period where even for 2, 3, 4 months the market just does nothing.
Well, I can't disagree. Like, obviously, we won't know till it gets there. I just feel that that's much too consensus. And you think everyone's looking for the Santa Claus rally. You obviously don't hang out in the bearish crowd enough, because to me it seems like a lot of these hedgies and a lot of these guys are looking for a big drop. And
I agree.
Yeah.
What sector do you think has been behaving the most bearish?
The most bearish? I am worried most about regional banks.
Okay, let's pull this up.
Yeah.
So let's look at KRE is the exchange traded fund.
Right,
for this.
and to me, this should have been doing much better, and the yield curve is crushing these guys.
Sure.
And it's ugly looking chart. And when we think about the tax savings that should have occurred,
flatteners are bad.
Flatteners are bad, but this thing should have been rocketing. Like and the fact that the banks,
I actually was dabbling with the long side, and we just pulled out, right? So there was a chance that we were going to see a reasonable recovery on that, but definitely I agree. Regional banks look awful here. This price action is just shit.
Yeah. So what do you think is bad looking chart?
The home builders. No, just kidding.
Well, let's talk about the home builders since you bring them up.
Well, you know what? Listen, I first of all, we'll bring up the home builders.
Yeah.
But to me, I just think the cyclical, the rotation is there. So anything that is cyclical, like you look at generally the basic material sectors, industrial.
What were you saying earlier about the poster child of this global synchronized recovery?
Caterpillar.
Why don't we pull the chart up?
In disclosure, I'm short cat.
Yeah.
And so what you have here with Caterpillar is well.
Look
okay.
at that Monday.
Well, first of all, this was the synchronized global growth. Here we have an established, tractor building company that basically went from $50 to 175. I know I'm rounding numbers,
Right.
but like
from
basically
2016 to 2018.
like a couple 100%
Yeah.
return, like if it was a tech growth stock.
Yeah.
Based on the synchronized global growth. And once everyone realized that it's a false narrative all along, at the time it felt like it.
Yeah.
Yeah, and I mean,
It's still $123. Like, it's not.
oh,
like,
but this looks like a Bitcoin chart, dude. Like, you know what? Honestly, I honestly think that Caterpillar has more to regress.
Well,
I'm not going to go and stick my neck out, but as we're going into global economic slowdown, who's going to be buying the dip on Cat? I think it's going to bleed for a while.
Well, the real question will be how much of a global economic slowdown do we have? And is it as bad as all you real true bears out there? Because although I am bearish, I think that this next recession will be shallow.
Okay.
So as people get really bearish, I will find myself taking the other side of the trade and saying it's not going to be as bad as everyone thinks, because I think it's not going to be too long before everyone's talking 2007 again.
Okay, we'll see. Let's look at the home builders.
Okay, the home builders.
Okay, so this is
well, can I just tell everyone something?
Yeah.
I get endless flack from Patrick. Like, it's like almost a daily email about the home builders. And because I made a call that I said, he asked me what was going to lead out of the next bull market. And
this is shit, dude.
I said the home builders, and he went, like, he gave me the patented Patrick Ceresna. Oh my god!
Oh my god!
And and not only that, one of his viewers was chastised me about this call. I still stick to it. I think that the home builders. Anyways, Patrick, you guys can't see it. He's shaking his head in disgust at me. I think you look at this chart, and if you compare,
it's glorious, isn't it?
It's glorious. If you look at it on a
all right,
let
me just for your little delusion. let me just put this is the chart of the regional banks over your home builders. Tell me what's the difference? One chart looks like death, and then this chart somehow looks spectacular. Give me a break, dude.
It's hanging in there.
No,
it's hanging
oh
in there.
my god. Oh my god. Okay, so you know what? Let's compare. I've been long utils. Yeah. Now I haven't been long REITs as much as I should have been.
Okay.
And I've been long. Actually, let's put this on a month. So I'm going to put this on like a 1 hour chart, right? And so we're going to go look at the month of November, right here. Okay, so let's compare. What do we want to put on here? Okay, so I was long the TLT. How does that compare?
Okay, so here's what I'll tell you.
Okay.
So first of all, why don't we have another bet? And Patrick, why don't you tell everyone what we're doing tonight?
Okay, we're going out for a steak dinner. On my tab.
And why are we going out for a steak dinner?
Because I lost the bet.
And what bet was that?
That we were going to have a recession in 2018.
Yeah, so when Patrick and I first met a year and so ago, he was all bearish for a change, and he was telling me how the economy was going to crash and all this shit. And I was like, I really don't think so. It's not going to be that bad. And we bet a steak dinner that the recession was not going to happen in 2018. And Patrick, like a true gentleman that he is, he's making good on the bet, and he's taking me out for a wonderful dinner at Harbor 60 with the rest of his staff. So I really appreciate that. But how about we go and we double up our bet?
All right.
So we'll say it right here. So you love the TLT, right?
Okay.
I will take the home builders, and you will take the TLT. And we will, whatever asset performs better over the next year, we'll have another Christmas dinner, like Christmas steak dinner. Are you on?
All right, we're shaking.
We're on. There we go.
Fine, we're on. It's
home builders versus TLT. There you go, folks.
All right. So TLT, by the way, for those not familiar with it, is the 20+ year Treasury bonds.
That's right.
So it's about outperformance of Treasury bonds over that of home builders. Equities against bonds. This is an interesting bet.
Yeah. Well, you're a big deflationist. This is a great trade.
This is a great trade for me. So
okay.
Kev, let's just move on. Kevin, This week in trading history, what's going on?
Well, we're going to remember back to December 4th of 1991. Charles H. Keating Jr., you got to always be worried about junior guys, the kingpin of the savings and loan crisis, is convicted on 17 charges of California state securities fraud. Okay, so he's the former chairman of the Lincoln Savings and Loan, and he's found guilty of making false statements and omitting disclosures about risk of junk bonds that were sold to more than 17,000 investors.
Okay, so what I want to do is just give everyone a quick summary of this, because what you see in that on a chart here on the left-hand side at the top corner is the number of U.S. bank failures that happened in the 80s and 90s. Well, I want to stop for a second and explain to everyone what was the savings and loan crisis. At least you can correct me if I'm wrong, but when Volcker shot interest rates through the roof and raised everything, savings and loans banks, which are not these money center banks, the credit machines that the big banks are, they need depositors to deposit and then lend out that money on the long term. They actually are sensitive to the curve. And so they went and locked in all of these longer term loans, and then the short term interest rates skyrocketed on them. And they could not come up with money at a rate that's cheaper than they lent it out long term.
Well, it was more complicated than that, okay. And then they were encouraged to try to do increasingly risky things to save themselves. So they ended up doing some crazy shit that just
that's because they were insolvent and they were lying about it, and so they needed to do risky stuff to try and get themselves out of the hole.
You're correct,
right? But these bankers went to jail.
Yeah,
this is different than the Lehman's, isn't it?
That is correct, and this story is fascinating because I kind of knew about the savings and loan, but then when I started researching Charles Keating, I was just like blown away. You know, he did some work for the FBI. Then he became a corporate lawyer. But before we do that, I have to say something about him. As I was researching him, he was a big proponent of anti-pornography.
Oh.
Okay? And I always worry about those who are casting stones. You know that guy's got the biggest collection of smut that you've ever seen, right? Right, and so he actually gained the nickname Mr. Clean. Oh. And I didn't realize
Mr. Clean.
Mr. Clean, not like the guy from Pulp Fiction that cleaned up after
that was Mr. Wolf.
Yeah, the Mr. Wolf. That's right. But so Mr. Clean here, he was actually voted by Oui magazine, and I think Oui is like Playboy for French people. One of the top spots of the enemy of pornography list. Anyways, it's just fascinating. But let's get on to his financial misdoings. Mr. Clean was maybe clean in his morals, but in terms of his sex life, but he wasn't so clean in terms of his finance life. If you look at him, he was actually involved with the American Financial Corporation, which then ended up buying American Continental. And in the period between 1987 and 89, its assets grew from $4 billion to $5 billion. They ended up buying all sorts of stuff. He would purchase the Phoenician, which was a big resort. He spent $300 million on that. He would fly his wife around in corporate jets, and they would go from opulent places. And then... but he was basically the kind of the guy from this era that represented the excesses of this kind of savings and loan kind of madness at the time, where they were just spending. Okay,
but now this Charles Keating, he went to the junk bond market to raise capital,
well,
right?
He went to the junk bond market to raise capital. He did both. He raised capital and then also invested in Michael Milken's bonds. Michael Milken, the junk bond capital king of the world at the time, he kind of...
Is that where he speculated? Is that where he made the big bets?
He made huge bets in that and lost money. So they made it in real estate, junk bonds, At one point, I read about how he was borrowing money and making big bets in the derivative markets about currencies and stuff. This guy was just.
Listen, from what I remember of reading, is that the Lincoln Savings and Loans was like $100 million insolvent.
No, it was more than that. I think it was $1.3 billion insolvent that they eventually cost the government.
So he started off though. So think of it. The way I think of it is very similar to the trader that was hiding the tickets in his desk. Like he realized that his little piggy bank company was basically insolvent, and because of lax reporting rules, he didn't have to disclose it, and so he's making desperate bets in an attempt to bail the company out, and it just in proper trading fashion, it gets out of control and it blows up on him. Am I wrong?
No. And what I think the funniest part about him is how he claimed Keating steadfastly maintained that it was not his mistakes or criminal deeds, but regulators' actions that were responsible for the major losses. And that's always the hallmark of like just one of these guys who's blaming the regulators for all the bad trades that he took.
Well, what a great story! Yeah,
so he was actually just the kingpin and the face of the savings and loan debacle, which goes to show you that the story never changes. You know, it really doesn't.
Except back then, bankers went to jail.
You're right, and that is the big difference between that and 2008. Was that nobody went to jail in 2008, and Keating, he did spend some time in jail.
Not as much as he probably should have, but he still did.
Yeah, and I don't know what the pornography collection was like in jail.
Let's move on. Kev, what is the WTF clip of the week?
I don't know how to describe it, so let's just watch it.
All right.
If I was Fed chair, I'd be pausing until we had a sequence of inflation numbers that were above 2% at the minimum, and not. I actually think 2% is too low a target, but that's you try and make that argument at the Fed and they go crazy.
That's the signal. Go. Let's go freaking get here. That's my shit.
The president now in an interview with the Washington Post has said, I'm doing deals and I'm not being accommodated by the Fed. They're making a mistake because I have a gut, and my gut tells me more sometime than anybody else's brain can ever tell me.
He doesn't look too good.
I'm not even a little bit happy with my selection of Jay Powell, not even a little bit.
Pump your brakes, kid. That man's a national treasure.
I just want to throw another shrimp on you, Bobby.
That shit ain't funny.
Hey, fellas, it's hot. We're tired. It stinks.
I'm fucking with you, Kangaroo Jack. I'm sorry a dingo ate your baby.
You know that's the true story. Lady lost a kid. You about to cross some fucking lines.
Guys.
Making those remarks in the Hamptons, according to Bloomberg, saying that he had some suspicions that Jay Powell wasn't necessarily doing the right thing in terms of interest rate hikes going forward. This is a criticism that the president has made before, including to Joe Kernan in an on-camera interview earlier this year. Here's what the president said back then.
Kill him.
This is Les Grossman. Who is this?
This is Flaming Dragon.
Oh, okay. Flaming Dragon. Fuckface. First, take a big step back and literally
face!
I put a very good man in the Fed. I don't necessarily agree with it because he's raising interest rates. I'm not saying that I agree with it, and I don't necessarily agree with it. I must tell you, I don't.
So whatever you're thinking, you better think again. Otherwise, I'm going to have to head down there, and I will rain down on a godly fucking firestorm upon you. You're going to have to call the fucking United Nations and get a fucking binding resolution to keep me from fucking destroying you. I am talking scorched earth, motherfucker. I will massacre you. I will
All right, Kev. That was a hosh-wash of all sorts of stuff.
Yeah,
okay, what inspired you? Kelly, what's going on here?
I was watching Bloomberg TV, and I saw Krugman, and I keep it in, Patrick. So I know he's kind of a funny guy, but I saw him make his comments about how everyone goes crazy when he starts to try to imply that we should have higher than 2% inflation targets.
Oh my God.
And I thought to myself, oh God, you know who else?
Spot the clown on the screen.
Yeah. So I thought to myself, you know who else agrees with Krugman that we should have higher inflation targets? It's President Trump.
All right.
And so
why didn't he put Krugman as the central banker?
He blew it. Like he really should have. He should have put Krugman, and he didn't realize it.
He listened to Mnuchin, and go with
well, let's face it, Powell's fairly hawkish. Apart from this recent move where he finally succumbed, but
a lot of people thought that he was going to be another Janet Yellen. No, I remember seeing those pictures where it was Janet Yellen's head, and then they put just Powell's face on it. I was under the impression a lot of people thought that they were.
No, a lot of people thought for the first time we were going to get a non-academic in there because Powell doesn't come from a background of being a professor of economics. They thought that he was going to be much more practical and that he was going to return to sound money. So it was never. I was always confused why Trump chose him because. To me, he always seemed like somebody that wouldn't.
But during the elections, Trump always said that interest rates should have been higher. So he's flip flopping all of a sudden. But he's flip flopping because he's realizing that the economy is suffering immensely from the higher interest rates, and now he's getting the cold feet about who he put into the president.
Well, he's looking for someone to blame. But
that's Trump's style.
Yeah.
But Krugman. That's a whole other can of beans. What I find really what most of you listeners don't know is we've had these conversations about Krugman before, but he is incredibly loose money. He's wants higher inflation. He wants a fiscal policy that is very loose, very accommodative. Governments to spend a lot digging ditches to places that go nowhere just to create jobs. He wants a very accommodative central bank policy.
He makes me look like a hawk.
Yes, he makes you look like a hawk.
Yeah,
he basically wants inflation to run, and maybe it will be someone like him that will ultimately be behind this scenario that you're baking as to how you deal with the large amount of debt as you go Krugman on it.
That's a great line. We're going to do that. Let's go Krugman on it.
Yeah.
I will say this about Krugman. I have a lot of problems with one aspect of his policies, and that is the fact that he views any spending as good spending. Whereas I'm much more particular. I believe that investment should be done for the good of the economy. So when he's the broken window fallacy, where he actually believes that you could break windows and get people to fix them, and that the society will be better off. And right. I don't buy that for one heartbeat. I kind of look at it as like a small business owner. If I went and took out a loan to borrow $100,000 and then blew it on the greatest steak dinner at Harbor 60 that we've ever had with all sorts of fancy dinners, fancy wines and stuff, that would be money out the window. Whereas if I took it and invested in computers and infrastructure for my business and made things better, that is a much different scenario.
Capital expenditures.
Yeah, and so Krugman doesn't give that nearly enough credit, and that's the problem that he too many loose kind of accommodative policies end up getting tarred by the Krugman brush of just spending money and wasting it.
Krugman brush.
So you know what? We're gonna disagree. We're going to agree that we both don't like Krugman, but for completely different reasons.
All right, let's move on. Kev, let's get on to the tales from the trading desk. You came up with this risk arb?
Yeah, the greatest risk arb of all time.
Right.
And this is something that I experienced firsthand on the desk when I worked on the Canadian Institutional Derivative Desk. And it actually involved another firm. It was Bear Stearns. And right. you might laugh, but Bear Stearns at one point was one of the greatest, shrewdest risk takers of all time.
I could never believe it.
Yeah, no, I know. And everyone kind of remembers the Jimmy Cain, smoking pot, playing bridge, losing all the money on the mortgage, Bear Stearns. But what you need to remember is that before that, there was a fellow by the name of Ace Greenberg. And Ace Greenberg was a guy who was instrumental in many of the years of Bear Stearns. And he was just a really, really smart guy that took risks that were very shrewd and really thought things through. And so I'm going to
So which one is it?
So it's actually a Canadian name, and the name is Metronet. And it was in the
what was Metronet about?
So Metronet,
I don't remember.
So Metronet was a telecom company, and for our younger listeners, at one point telecom companies were the kind of the fangs of the .com bubble. They were
and ended with Nortel.
Yeah, so there was Nortel, Lucent, and all these crazy things, and one of them was Metronet, and Metronet was a Canadian telecom company, and AT&T, the big, huge conglomerate, came in and decided that they wanted to get into the market and they were going to buy it. But the trouble was that they needed to buy it and they needed to get regulatory approval, and the regulatory approval was going to take years. So usually when you buy a company, you enter into an agreement to buy it, and it might take you 6 months to get everything done. So you do it that way, and you spend the 6 months, and eventually it trades, and then it just gets taken up. Well, the problem with this is that when you're doing something for 3 years, the people holding the stock, why do they hold it? It's going to be difficult for them to hold something for 3 years. So AT&T said, I'll tell you what we'll do. We'll pay you $60, I'm just dreaming up the number, and we'll give you 3.5 every year more. So they basically paid an interest rate on the actual amount that they would pay for the company
until the deal's
done, because they weren't sure whether it was going to take a year or 2 years. It was good, but it was going to take a while. So this is just kind of like a risk arb's wet dream. You got you have a huge conglomerate buying a company and giving you a coupon for the longer.
So what year was this?
So I think it was the late 90s. And,
okay. So before the 2000 crash. Before Nortel and everything.
Right. So, but it's funny you mention that, because then when the 2000 crash came, they still hadn't bought the company. It was still outstanding.
It was.
Yeah. So what happened was all the other telecom companies started sinking in value. But Metronet, which AT&T had promised to buy with this ratchet higher, was still trading at the same level because it was no longer going down with everyone else because AT&T was going to buy it.
Right.
The interesting thing about it was that as the telecom crash got worse and worse and worse, it got to the point where all of a sudden the risk arbs started to worry about the fact is, what happens if AT&T walks away? So if you think about the math about how a risk arb the person would value a deal, it's they assign, let's say it's a 90% chance that the deal will go through, and at which point I'll make $1, and a 10% chance that I'll lose $5. And then they'll do an assign a possibility, and then they'll come up with it, and it's a risk-adjusted return.
Yeah.
But as the value of the other telecom companies fell, it became increasingly clear that if AT&T did not buy Metronet, instead of losing just $5 or $10, you might lose $30, like 50% of your investment. So what happened was the spread started widening to reflect this increasing concern. Well, this continued, and the market kept getting weaker and weaker and weaker and weaker. And it got to the point where if you kind of imagine a company as having an enterprise value, meaning bonds and stock, and let's say the enterprise value for Metronet was $7 billion. And let's say that it was $2 billion of equity and $5 billion of bonds. It got to the point where instead of them valuing the whole piece at $7 billion, they started to say, the market started to kind of collectively decide that it was only worth $4 billion.
Wow.
So what does that mean? That means that the bonds, which were previously trading at around par, were now trading at like 85 cents on the dollar.
And when the equities were getting killed too, right?
Well, the equity, so if Metronet had been trading as a public, like without the risk arb, then what would have happened is it would have gone from $60 down to zero, basically,
Right.
And it would have traded like a call option on that. But in the meantime, AT&T has promised to buy it for, let's say, $2 billion.
It's still outstanding.
And it's still outstanding. And this is where Bear Stearns gets into the picture, because they must have done a huge amount of work. Because what happened was the bonds started trading at 85 cents, and then they went to 80 and 70, and somebody big was selling them, was just pounding them out. At the same time, what was most confusing is if the bonds are only worth 75 cents, generally you would think to yourself that the equity is worthless.
But it's not.
But it's not, because in this case there's a risk arb. So as people got nervous about the bonds, more and more people sold the stock. Well, what Bear Stearns had decided, and it kind of researched it, and it decided that it was rock solid. There was no way that AT&T was going to get out of the deal paying $2 billion or whatever the amount was for the stock. So they started buying the stock in size, and because of the fact that the bonds were trading so wide, the stock was just being given away. So it was trading with a huge kind of implied arb if the deal went through. And then, so they bought the stock, but interestingly enough, they shorted the bonds. And that kind of is the opposite of almost all kind of capital structure arbitrages that you go through. Because usually if the bonds are not worth par, then the stock is worth zero.
Yeah.
Right? Because if
it makes sense.
Yeah. So these guys at Bear Stearns figured out, and they made the bet that AT&T was going to buy the stock. But here's the really genius part. Not only were they going to buy the stock, they were going to walk away from the bonds, because there was no way they could get out of the stock deal, but there was no obligation for them to take the bonds at par.
Right.
So they shorted the bonds, bought the stock.
And what ended up happening?
It ended up that AT&T paid the full $2 billion for the stock and walked away from the debt. So,
like to zero?
Well, the bond, it started trading at like, I can't remember what the number, 20, 30 cents on the dollar. So Bear Stearns made on both sides. It was just unbelievably. First of all, the guts to be long these bonds, the stock that is essentially worth zero, because you know that it's worth zero because the bonds are trading. So you're assuming that AT&T has no wiggle room to get out of the deal, but yet you're also going short the bonds because you are, after all the research, decided that they're not going to go and actually take up that debt. So it's just...
What a great story.
It's just unbelievable that these guys...
You know what? You can't find this on any other show. Like where else do you find someone digging up a story? Like, I didn't hear about this story. What a great one.
Yeah, no, my respect for Bear Stearns from that, watching them is immense. And for me,
Did you drop your resume over there afterwards?
Well, no, I didn't drop my resume over there, and thank goodness I didn't, because Jimmy Kane blew them up.
All right, let's move on.
Okay, Patrick, now on to the top 5 things to watch next week. But before we do that, let's review last week and see how we did. Let's start with number 5.
Well, number 5, I was looking at that U.S. dollar against the Canadian. Now, we did temporarily break above the 134 level. Now we're sitting just below there right now. But...
Well, what formation is that?
You don't tell me you're calling that a prairie dog.
I am calling it a prairie dog.
No, oh my God. No, stop this. The Canadian dollar is going lower.
Okay, we're going to talk about this in the things to watch next week. So let's just leave it at that.
So number 4.
Number 4 was the jobs number. I was looking for a weak jobs number, and I think it came through weak. Most people interpreted it as weak.
Wasn't it interesting, though, while it was weak in the U.S., that we had, I think it was a multi-year high print on the Canadian jobs numbers?
Yeah.
Was that an anomaly?
There's a lot of volatility in these numbers, and you shouldn't be too close.
There's no way that was a
Having said that, you're way too bearish on Canada, and we'll have to talk about that in the thing. Let's go on to number 3.
Well, and Canada didn't hold its bottom.
No.
It made a lower low. The bleeding continues. Now, oil has stabilized. We still see the lows coming? We'll see. But right now, the whole market is weak. You can't have a stock like this buck the trend when you have such broad distribution. But anyway, move on to number 2.
Well, it got changed. Powell speaking Wednesday got changed to Thursday because of President Bush's funeral. We were watching for Powell to see whether he might, walk back his dovish tilt. He some people interpreted it as slightly bearish, more hawkish, but on the whole, it was kind of a push. It wasn't a big deal.
And then number 1 was G20. And we both said that they were going to go into that meeting. It's supposed to be smiles, photo ops, shaking hands, making it look like the world is working together. But that lasted 24 hours.
Yeah, before President Trump was tweeting something.
And they arresting
Chinese
executives.
It's actually, while you're mentioning that, arresting the Chinese executive, the market took that very poorly and assumed that meant that Trump was pushing, kind of escalating the situation. Here's my call on that. I actually don't view that as bearishly as the rest of the market. My suspicion is that the Chinese government actually were fine with that, and that was pre-approved, or they knew it was coming and they had no problems with it. I think that there was some guy who used to work for SAC. Steve Cohen's firm, that he's a famous macro trader. Anyways, this fellow mentioned something about the fact that there was a merger that was approved by the Chinese government post the arrest that indicated that they were still okay with these mergers happening in the U.S. So I really think that this whole
it was just maybe what happens and is very typical of media is that something happens in the markets and they're all looking for excuse. Something that was the reason, and sometimes there isn't a reason.
Or the market wants to sell off and is looking for an excuse to sell off, and I think that's more important. I actually think that this arrest is not as big a deal as the market believes.
All right, Kev, let's move on to the top 5 things to watch next week. What is number 5 in your mind?
Well, for me, I'm watching Australia dollar CAD cross rate.
Oh my God!
And I know, because you know what, you're super bearish on CAD. True Canadian, always thinking the Canadian dollar is going down. And I love CAD here. I think...
Okay, let's hear your story.
Okay. I think all you jokers have built in the absolute worst kind of... All the bad news is in the market. Our Western Canadian Select crude went to $10. We almost couldn't give it away. It's on the front page of every paper. We finally have even an NDP government buying tanker cars and actually shipping it to the U.S. I just think that it's buying blood in this.
Okay, but so what's the story behind the Aussie against the CAD here?
Well, I like CAD outright against U.S. as well. But I also like it against Australia because although I love Australians and I think they're great people, I think they've blown even a bigger housing bubble than we have as Canadians. I think that their economy is much more sensitive to China. I don't think China is going to be doing well over the short run. I think that we're in a kind of a liquidity contraction, and that's going to affect Australia much worse than Canada.
So where I'll agree with you, I will agree with you, is I feel that in my narrative of the global economic slowdown, because emerging markets are the centerpiece to a broader slowdown, that Aussie is going to get hit by it, and maybe more than Canada. So to me, the interesting part of this trade idea by you is the fact that we're removing the US dollar out of the equation. We're playing a game of what is going to be relatively weaker against the US dollar. That I could see. But I don't know if I would buy your argument that the CAD is a great buy here. So I'm only going to agree with you on half of this trade.
Well, so you'll agree on the odd CAD,
Australia can be weaker than Canada.
I think you guys are way too bearish on Canada. I think you're way too bullish on the U.S. I think that you guys are way too bearish on energy. I think that the bad news is all in the market.
I just can't believe the CAD isn't down to 72 cents.
Well, I think that's telling you something, isn't it? And not only that, God. You look at the numbers, our economy is doing better, and everyone is one thing about the U.S. dollar, everyone tells me I can't go and do anything but buy U.S. dollar because everyone else is so shit. And I hear that all the time. Like, I'm like, oh, what are you going to sell U.S. dollars against? And I kind of contend one thing. The world is overweight U.S. dollars. Big time.
Okay.
Okay?
But there's a shortage.
Well,
dollar funding shortages.
I don't know, but everyone knows that, and everyone has too much. The Brent Johnson milkshake theory, everybody is long U.S. dollars. So all we need to have is just a return to
what the first quarter 2019 is this return?
I think that you're going to find the U.S. dollar be for sale in the coming quarters.
The biggest, where I think that you may fall on the side of error is just simply your timing. I think that you're going in that your scenario is a Luke Roman bigger picture thing. I think that
no, wait 1 second. Luke thinks the U.S. dollar is going to come crashing down because the world is going to end versus the U.S. dollars. Luke, I love you, but but I think that everyone's overweight, and all we have to have is a return to the benchmark. So you're a central banker, and you're overweight U.S. dollars. All we have to have is them a return to their benchmark, and they'll be buying other currencies.
Late 2019, 2020, I might buy it. I don't think it's happening the first half of the year. This is one where I'm going to disagree with you. But let's watch. The Aussie CAD, maybe it will work for you because I see the logic in it, but I'm not. I'm more bearish candidate than you are.
We'll agree to disagree.
All right. So number 4, I'm watching Goldman Sachs, and for me, this is what an unbelievable story. I mean, they've just. I'm gonna just put up a chart for this. This stock, we had an S&P 500 that mustered up a rally from like 2620 all the way to 2,800 on a kumbaya rally on the G20. And everything was good. And Goldman Sachs could not muster up a $10 reaction off there. You can't barely tell on the chart that it upticked.
That is the technical formation of shitting the bed.
That's right. And you know what? And rightfully so. It stings a little bit because I had puts sold on Goldman, which is going to be evicted from my portfolio. But what a disappointment this entire move is. Is this the Deutsche Bank of the States now?
It's not.
Okay.
Deutsche Bank is so bad. There's no way you can even put them in the same.
No. But this just seems to have such a relative underperformance to everything else.
I don't know if I can give you a prognosis about where it's headed, but I will tell you one thing: that after years of watching Goldman Sachs in the market, it's tough for the market to rally without Goldman Sachs doing well. And I don't know why that is, and I don't really get it.
I've heard that before.
But I often watch Goldman Sachs for clues about where the market is going. And so you see a situation where the market's rallied in the morning, but Goldman's rolling over. Yeah. It's something to keep in mind and keep your eye on.
We're in a little no man's land here. I mean, this thing down to 150, 140. Wow. It's anyway, Goldman's weak. What's number 3 in your mind, Kev?
Well, it's Europe, and it's a million things. We have the Brexit vote, so
the EU on the EU side, not
UK lawmakers on Tuesday will vote on Prime Minister Theresa May's Brexit plan.
But then there's a EU court ruling.
Yeah, and it's I don't know, those Europeans. It's what it.
But then and this is we're not even mentioning France in this. No yellow jackets, right?
Yeah.
But then we have the Italians having to come back with their budget.
Yeah.
With their new budget, and then of course Mario Draghi,
right?
The ECB.
One thing, this yellow jacket, isn't that like a wasp? Isn't that is that just
That's a Canadian wasp?
Is a Canadian wasp? Is that all I know? Because maybe the people will view them as wasps, but it's just a disaster over in Europe. And for those that are getting too bearish though from all this, and this is what I want to warn everyone. It seems like terrible news, and it seems awful. And there's people protesting, burning down shit. It's a disaster. But I contend that the quicker this stuff happens, the more likely we are to eventually get to the fiscal stimulus that is needed. So
how does Mario Draghi? What's the next step for monetary policy? He was not able to even raise interest rates from their negative rates. He hasn't even been able to taper off their bond buying. Where's this easing that you're talking about?
Because it's not. This is the problem. It can't be done on a monetary basis. It has to be done on a fiscal basis.
But that has to be who provides the capital for a fiscal basis? Well, I mean, look, they're not even letting Italy
it doesn't matter.
run a 2.4%.
You don't need capital because the reality is that Mario's going to underwrite it. Bond rates in Germany
but why won't they let Italy run a larger deficit then?
Because they're crazy and they're sitting there.
Why do you think that there's going to be an imminent change then?
Because the longer they continue with this, the more we're going to get yellow jackets, bumblebees, whatever. It's going to be a million.
Listen, look, I'm not going to disagree with you, but I'm thinking you're wrong on the time frames again, because I think things have to get a lot worse, and there is no way that in the first or second quarter of next year that these kind of changes. You're talking in the bigger picture. You're dead right. I just think the idea that this stuff is imminent now, with the way that they're treating Italy and everything like that, I think there's no way the first quarter of next year that you'll see any meaningful easing or anything.
Bought from you, because I'm on the other side of that trade, and I think the more disruption we get, the more protests, the more likely it is that we'll get what I'm looking for.
And that's just going to happen over the Christmas holidays.
I think that I think it's going to continue to get worse, and they're going to do it more quickly. The worst thing that could happen is them to just go into a Japanese-style acceptance of it. And if that was the case, I would be much more...
I don't think there's an out for them, though.
Sure there is. It's really simple. They just go and spend and print.
But how do you deal with the fact that there's a perennial problem with Europe of the fact that they want national sovereignty but monetary unity. You can't get any of the parties or countries to see eye to eye. They're all in spite of each other. Like, the Germans don't want to allow easing for the Italians. Italians want this from that, and they're all going back and forth. Listen, I would buy your argument if this was the U.S., the United States of America, where there's one federal government that is trickling things down. I just don't buy your Europe Kool-Aid. I won't. Yeah, that's the Europe Kool-Aid that you're selling. I'm not buying.
Well, okay, then we'll see.
All right, let's see what happens. Anyway, let's move on to number two. Number two for me. Will we see those 52-week lows? You can see when we showed that chart on the S&P 500, we were showing that we were triple bottoming. What was your saying about triple bottom?
There is no such thing as a triple bottom.
All right, so there is no such, and until it happens, but there is no such thing as a triple bottom. Kevin Muir has spoken. So with that said, here you see the chart. We went down to these lows 3 times. And the green box represents the February and April kind of low zones. Will we see 52-week lows in the next, maybe not just next week, over the next couple of weeks? Will we see that the bear market advertises itself? Because to me, a break to fresh new 52-week lows is an advertisement that bear market is game on. And will we see it next week? That's what I'm watching.
Well, and I'll take the other side. I'll say this. I think we see the break that you're looking for, and then it gets bought for a Santa Claus rally. Just when all the technicians say, we've cleared this triple bottom, time to get bearish, that'll be when it surprises everyone and rallies.
So where I will buy that is if we were to print down to around 5,200, that's technically what we call a measured move.
5,200 or 2,500?
2,500, so thank you. That's dyslexia kicking in here.
But it's okay, you don't do anything with numbers for a living.
I don't do anything with numbers. It doesn't matter. If we printed 5,200 and then we reversed into a bounce.
2,500, yep. Keep going, though.
It's the beer.
That's right.
This pompous ass
that's
beer.
Right. So 2,500, if we print 2,500.
And we reacted into a Santa Claus rally, I'd buy your Kool-Aid.
But if we react into a Santa Claus rally, it's already going to have risen. So at 2,500, you buyer or seller?
I'm a buyer.
Okay, so you're agreed with me.
Yeah, but I mean you're talking about a market there that's going to still drop 150 points.
Oh, okay, but at this rate, we're having 50-point days.
Yeah, that will be in 2 days.
Yeah. So, anyways, I'm just saying. All I'm saying is be careful getting too bearish into those holes. And that is really the lesson the message I want to send.
Selling fresh new lows is dangerous. It always is.
You want stock markets
this is why I was so interested in shorting 2,800, not 8,200. Yeah. 2,800, because the risk reward is there. It's easier to manage. Selling at under 2,600, you don't have risk reward in there. At that moment, you have less profit potential than you do have when the trade squeezes against you. It's not a good entry.
Yeah. So that's just the hallmark of bear markets is you get those sharp, spikes, and they're and
they hurt.
And you look for levels. I look for time, and I kind of feel like they're 1-2 days tops. That's what I look for. 2 days, big rally. You get 3-4%. I don't care what level it is. At that point, I'm pulling the pink tickets out.
All right. Let's move on to number one. What's your number one, Kev?
Well, we have a slew of Chinese data, and I think a lot of it comes out over the weekend. So kind of when we get into work Monday, we'll have seen it. I suspect the economic data will continue to be bad. So it'll be interesting to see how the market reacts to that. I assume that the market will take it poorly. But I do think that it's important to watch and to see how the Chinese react to it as well.
All right. Well, you know what? Let's watch it. I think it's a pretty big deal. So that's your 5 things to watch. Let's move on. Kevin, it's time to slowly wrap up the show, but we always love to leave our listeners with some words of wisdom. So what did you dig up this week?
Well, we spoke about Bear Stearns and Ace Greenberg, and I thought I would just kind of leave us all with one of his comments about risk and managing risk at a trading firm. Every Monday, I chaired a meeting of the risk committee, whose agenda was to enforce limits of the extent of our capital exposure. Traders from 8 or 10 departments attended, knowing that yours truly would react quite unhappily if anyone was found holding a loss. As a rule, losing positions got sold on Friday, and I didn't care how nasty a hit we had to take by 4 p.m. Monday, all the dogs had better be off the books. I heard that, and I can't tell you, that sort of discipline is so important because it's often those kind of crappy dogs, as he talks about,
that turn into monsters.
Oh, and just the discipline of getting them off the sheets is so important. And if I was to give advice to kind of a new trader or even anybody, it'd just be get rid of your losers and just those things that end up taking all your mental energy. They're just better off the sheets.
I haven't had that kind of discipline, but I commonly will sell down my losers. So if I always say the things that work the best should start working right away. And if I see something isn't working, then I make it less important to the portfolio and I sell it down. Now, maybe, in this example, he was just killing it outright, but you want to make sure that you're not stuck. And the biggest problem, so many retail investors do the opposite, right? When a position is going down, they double down.
Right. And I actually have similar things. Whenever someone's asked me what should I do with a position because it's not going my way or I'm having trouble with it, I always say have the position.
Yeah.
And then think again. And if you're still having trouble, have it again.
You gotta kill the ones that aren't, because those are the ones. I look back at my trading career, and it's those positions that I should have cut out early that end up turning into the portfolio killers, right? And you have to think, and that's one of the reasons why Goldman Sachs is getting the boot. Nonetheless, let's wrap things up here.
Okay, well, thank you for spending some time with us. Please visit our site at markethuddle.com to sign up to receive our weekly email that will include a link to the show and the charts that we discussed. Rest assured, we will never clog your email with junk, and we will only send you our weekly letter and updates for our upcoming shows. Also, please follow us on Twitter at themarkethuddle.com. And for those listening on a podcast and would like to view the charts we discussed on the show, please visit markethuddle.com where the full video for the show can be found. Yeah, and actually before we leave, a big thanks and a big shout out to Great Lakes. I'm having too much fun with the beer. Yeah. Great Lakes Brewery with the Pompous Ass. What did you think of that?
Actually, it was a rather good beer for being a pompous ass.
Yeah, no,
I've never drank ass before, but.
Okay, on that note,
on behalf of Patrick Ceresna
and Kevin Muir,
we'll see you all next week.